Hello, everyone, and welcome to the Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'll be your host today. I'm Brian Daingerfield, and I co-head the G10 FX strategy team here at NatWest. And today, I'm happy to be joined by Galvin Chia, who's joining us from Singapore, who covers emerging market foreign exchange for us here at NatWest. Galvin, thanks very much for joining.
Hey, thanks, Brian. Thanks for having me.
So, one of the big themes for 2024 is on the geopolitics side, and specifically elections. There are many major elections taking place throughout the world in 2024 that have the potential to really change up the political and international relations landscape. For those of us here in the U.S., the Iowa caucus was this week, which sort of kicks off the primary season in the U.S. And so it's a reminder, maybe a sobering reminder, whether we're ready or not, the 2024 election season is really kicking into gear. And there are major elections happening all over the world. But we've actually already had one big election take place already, and that is in Taiwan. And so very happy to be joined by Galvin this week to talk about developments in Asia. And I want to start with Taiwan. If you could set the background for us, Galvin, what happened in the election that happened over this past weekend? And what do you think it means for broader relations between both Taiwan and mainland China and also between China and the West?
Yeah, I think it's really interesting because, as you mentioned, right, this idea that politics moving markets, I think would really, we think really should hit markets in full force this year. It should be a pretty prominent theme throughout the course of 24, right? So just over the last weekend, what we had were presidential elections, which happen every 4 years in Taiwan, and at the same time, that's accompanied by the sort of parliamentary elections. So what we had, to long story short, was that the Democratic Progressive Party, their candidate, who was the current vice president of the island, William Lai, he basically was sort of the polling favorite, although his lead was kind of narrowing into the end of the opinion polling period. But he came up with a pretty decisive win over the next candidate from the Nationalist Party, the KMT. In the parliament, it was a little bit more mixed, and I think it's been sort of the first hung parliament that we've seen in over a decade or so. So basically, the implication is that while the DPP does have the presidency, their ability to push through some of these sort of legislative processes is going to be could potentially be met by some resistance in the parliament. So I think, long story short, though, the DPP has over the last couple of years, right? This is the third presidency that they'll be sitting in. It's pretty unprecedented in Taiwan's sort of electoral history. But what that means is that they've been leaning sort of more towards the U.S. And I think sort of the initial knee-jerk reaction was, okay, maybe this means that we'll get a little bit more of a heightened geopolitical tensions over the coming administration's period in office. So I think that's what markets have sort of thought about, but still kind of early days there to see the sort of full ramifications.
Yeah, I think this is a point that you've made as well, is that this is really a continuity government as much as anything. The former vice president is now won the election for president. And another point I wanted to ask you about is, I believe the current president in the election just passed, the winning candidate also didn't win with majority. Is that correct? So maybe the ability, as you said, the mandate necessarily to move in a much more, much further in the direction of the West is maybe not as strong as it might have been otherwise. Is that a fair interpretation, you think?
Yeah, I think you're right. Like, he didn't. So William Lai, who won, I guess, who won the elections this round, he didn't win with a majority, but he won with enough of a majority, or rather, the simple majority over the other candidates to be elected. So I guess in that sense, there isn't too much. I mean, some pundits across the straits have said, that might question sort of the legitimacy. I think ultimately, though, like, there are constraints, right, to this, and I think this is the crux of it, is that there are constraints to what the Taiwanese administration can do, and sort of what the tendency is and what the desires are of the Taiwan people. So I think in the press you get this sort of titanic struggle between democracy and authoritarianism, or war and peace. But I don't think it's ever so clear cut, right? Because despite this idea that Taiwan has a lot of these like sort of independent minded or separatist minded elements, the polls do show that for the vast majority of people over the last 5-10 years, people just really want variations of the status quo. People want to live their lives and earn their wages and get by. And that's kind of the sense that we got as well when we were in Taiwan, sort of in October last year, meeting clients, and they thought that for them, politics at the end of the day meant business as usual, and it meant they could go on with their lives. On the other hand, I think it does seem like the U.S. and China are very, very aware of the potential for things to spiral into sort of broader conflict. There's a lot of saber rattling that still goes on, but at the same time, I think what's also important is not just about Taiwan as an independent actor, but it's caught in this sort of three-way between as you mentioned, Brian, Taiwan, the US, and China. And right now, over the last couple of months, I think it's interesting to note that in this context, Chinese-U.S. relationship, the China-U.S. relationship is improving, right? We've had a year of pretty terrible relationship, and I think they're definitely working hard at very high levels of the government to try to reestablish contact, not only diplomatically, but militarily as well. So I think that should hopefully constrain the extent to which tensions at least can rise across the Taiwan Straits in the sort of the next maybe 6 to 8 months, that sort of time period.
I think that is good news to hear, as geopolitical conflict seems to be increasing in multiple fronts in the geopolitical space. Maybe a continuation of the status quo, not necessarily a big moment of escalation necessarily around the corner, I think would be good news on this front. Very interesting. You mentioned the improvement of relations, or at least the signs of trying to thaw relations between the U.S. Biden administration and the Chinese government, because of course we have an election coming up here in the U.S. in a few months' time in November that will, of course, provide a big opportunity to potentially shake up things from our side of the Pacific Ocean. So I do want to turn now more closely to mainland China, talk about some of the economic activity data that we've seen there. I think it's fair to say to start out 2024, the data have been disappointing, that generally, we've come in a little bit softer than expectations. And as that data has come in a little softer, it sounds like officials there, both from the monetary side and the fiscal side, may be thinking about additional stimulus to try and support the growth backdrop. From an asset perspective, it doesn't seem like the market is all that fussed about new stimulus, seems to be taking their cue a little bit more from the weaker data. Is that how you're seeing things? And how are you thinking about the Chinese currency as we face these sort of differing signals with growth a little bit weaker, but stimulus expectations maybe rising a bit?
Yeah, I think actually it's a really good contrast that you mentioned that. So, let's say with Taiwan, where, the sort of the geopolitical risk premium on assets on stuff like Taiwanese equities and the Taiwan dollar has actually been in flux. And some of our own analysis suggests that it's actually it's pro-cyclical with the market. So as the market sort of deteriorates, that risk premium increases and vice versa. But in contrast, what's been a very strong constant in Chinese assets is this huge risk premium that's just been escalating and escalating and escalating. And despite the fact you get ups and downs in Chinese data, as you sort of mentioned, but asset prices sort of keep heading lower. Equities are weakening. Bond inflows have actually started to turn a little bit, but and the currency remains weak. So it's kind of a really mixed bag, and it's sort of like this eternal falling knife that everyone sort of seems to be waiting to catch. The data was also a bit of a mixed bag as well. On the one hand, you had a pretty, encouraging signs, I would say, in terms of the growth numbers from stuff like industry and some parts of investment. But on the other hand, consumer activity remains a little bit sort of constrained. And ultimately, right, the one thing that people keep, have turned their gaze to and are fixated on is the property sector. And that continued to show quite a bit of weakness, right, in terms of investment and particularly in terms of prices, right? So again, it's a really mixed bag. Overall, the growth in 2023 was 5.2%, which according to the Chinese authorities, beat their target of 5%, which for them was good. But it's a very difficult time, I think, to be watching China in this current phase. I think it's difficult to really assess how well or how poorly the economy is doing. Like 5.2% at the headline number, that's better than 5% what they targeted. But at the same time, everyone is saying that investor confidence is weak. The property market still headed south. So they need more stimulus. And it seems like the central bank sometimes is caught up right between those two narratives. They think that, the economy needs more stimulus, and so they might cut interest rates. They might prompt the sort of fiscal and credit levers. But on the other hand, GDP numbers are coming in line, so we don't need to do anything about it. I think the market does seem a little bit caught up in that messaging as well, and the default seems to be just to stay bearish on Chinese assets in general.
Yeah, I think you just alluded to where I was going to go with my next question, which is thinking specifically about the currency. You mentioned this risk premium sort of in Chinese assets as a whole, and the very low rates in China and the prospect for rates to continue to be cut further. How are you thinking about the Chinese currency, with these drivers as a backdrop?
Yeah, I think that's actually a really good point because in this current interest rate driven environment in FX, lower interest rates in China would naturally mean sort of weakening pressure on the onshore and offshore renminbi, right? And I think that's definitely at the forefront of the authorities' minds as well. Which there are lots of speculations about why they might not be cutting, but that was raised as one of the sort of pundits' sort of rationales as to why they may not be cutting. I think ultimately, the Chinese currency does seem to me to be sort of pointed a little bit weaker. Probably in the 720 region right now. Actually, no. Well, we're about 720 right now, so it seems to be about right where it is, I think. And I think ultimately, though, so much of this has been driven has basically been driven by the dollar. The moves over the last 2-3 months or so have been driven by the dollar, but at the same time, we've also had very forceful intervention by the PBOC. Not just sort of signaling, getting banks to what we think are intervene in currency markets, sort of draining liquidity, squeezing out the short sellers. I think that's helped sort of cap some of that weakness. But ultimately, I think the bias so far, in terms of the overall policy stance, is that they probably do want to keep the currency on the weaker side, given the fact that all signs are really pointing towards China's sort of industrial policy, trying to revitalize its industrial and export engines. So in that case, having a weak currency does help.
Yeah, and from the currency perspective, the dollar CNH, dollar CNY exchange rate, there's two sides of that coin, right? There's the China side, but of course there's the dollar side. And as you mentioned, the dollar side has been doing a lot of the heavy lifting recently. As we've discussed in our previous podcasts, talking more and focus on the dollar weakened pretty substantially against a lot of global currencies in December. We came into 2024 thinking that move was perhaps overdone. Directionally over the medium term, probably the right direction towards more dovish Fed and weaker dollar on balance, but probably felt a bit overextended in the end of December. And we spent most of the month of January bouncing back in a lot of cases. And so I think you've seen some upside to start the year in the dollar versus Chinese exchange rate, simply because of those developments in the dollar front. But I think from the China perspective, as you mentioned, there is that risk premium. There are those lower rates to contend with. If we can expand a little bit, I did want to ask you about India. I know this is an economy that you've been constructive on for quite a while, and I think the market narrative on India, on Indian assets, has really been improving. I think the overall backdrop's been improving, but the currency's remained in a pretty tight range. First of all, do you agree that the market narrative may be improving a bit in terms of the fundamentals on India? And do you think that's something that could lead the currency to maybe appreciate a bit more clearly after months of fairly stable price action in dollar rupee?
Yeah, I think you're right. Like, I think the market is very optimistic, and I think it's got good reasons to be. India to us looks like one of the prime, the foremost growth drivers in the world, right? Whereas that was previously China, high single digits, right? Like that's really looking like it's going to be India, like last year and probably over the next couple of years as well. I think it's interesting that you mentioned sort of in the context of these dollar gyrations, because over the course of this last cycle, the last 2.5 years or so, so much of the price movements in Asian currencies has been driven by this global dollar cycle, and to the point where it's been just incredibly frustrating to try to think about, the relative outperformers and underperformers in Asia, because it's all just been so much about, correlations with the dollar. India, on the other hand, over the last, 3, 4, 6 months or so, has been remarkably stable. It's had high interest rates, but what's also been incredibly sort of interesting, or perhaps frustrating if you're on the other side of the coin, is that the central bank has been effectively intervening to keep interest rates, to keep the exchange rate almost stable, right? It's crushed volatility. It's squeezed out any possibility of short sellers in the market, and effectively it's kept the Indian rupee as a very effective carry currency in the region. It's got pretty high interest rates. It's been very stable, and there's a very bullish narrative building around Indian bonds because of the fact that it's going to be included in some of these global indices later this year. So definitely, I think on Indian assets, people are really sort of constructive, and I think that's in very much contrast to, as you said, right, these gyrations, these fluctuations, these reevaluations on the path of the Fed and the U.S. economy. So I think in that context, we're still constructive. We've been constructive for quite a while. It was one of our key sort of calls at the end of last year in our year ahead. And I think, from the fact that, it's stable, it's got carry, that, perhaps leaves it open to relative opportunities against other currencies, which you think might weaken a little bit because of fundamentals or relative interest rate differences.
So can I ask you about the policy strategy behind keeping the currency in such a stable range? Because I feel like for so many economies across the world, currency, for better or for worse, has been a big impact on inflation, right? There are some central banks that are very aggressively leaning against currency, have been leaning against currency weakness at times to try and encourage lower inflation. There were bygone eras where central banks were pushing in the other direction, trying to fight back against the weak dollar for growth related reasons as well. Can you talk a little bit about the strategy you think why the Indian authorities have been trying to keep the currency relatively range bound? And what do you think the conditions that might be needed for them to maybe allow for a bit more currency volatility?
Yeah, absolutely. I think it's almost like, to me, this seems like a bit like a question about, like, oh, what's your favorite Marvel movie or something like that, right? Because every analyst has their own favorite theory, and the RBI have been so tight-lipped about the currency to the extent that you can basically never get anything out of them at any of the press conferences. So for us, our sort of fan theory, right, if you will, is that on the one hand, they do want to replenish their dollar reserves. As the dollar was appreciating, they leaned very heavily against that because this memory of the taper tantrum in 2013, where they saw something like a 20% depreciation over the course of one or two quarters, was still, I guess, like, left a very, very deep impression. So they leaned heavily against currency depreciation, rightly so. They drew down a lot of the reserves, and for them, I think pitting the currency into this very, very tight range has helped them replenish some of their reserves by selling rupees and obviously buying dollars. Right now that their reserves are sort of back to where they were earlier, about 600 plus billion US dollars, people are saying, what's next? I think for us, there are sort of two considerations, right? Our sort of, again, fan theories that, number one, you have sort of the elections coming up later this year. And the fact of the matter is that, I think across all sectors of the economy, financial sectors and economic sectors, you want to try to keep growth humming. You want to try to keep, financial conditions stable. And that's probably a big part of it. Second part that we think is probably a big consideration here is attracting portfolio inflows and investment inflows, right? You keep a stable political environment, right, in the elections. You keep stable policy, right, again, elections. We think that Modi is going to win another term in office, which means that policy continuity, very favorable environment towards foreign firms, investment and manufacturing. So it's similar in a sense to China because it seems like both of these major economies, major Asian economies, are very much trying to compete for different parts of the manufacturing share. And it seems like, at least thematically, at a very, very high level, part of that involves, trying to stabilize the currency.
Yeah, I feel like in a world of, at times instability and lots of uncertainty, a central bank pushing towards stability and in the currency is certainly understandable in that sense. And I think, you really sort of wrapped it up nicely when talking about the election because, India is one of many major economies that's going to be holding critical elections later this year, along with Taiwan that we brought up at the outset. So I think that's all we have time for today. Galvin, I want to thank you for joining. And to our listeners, thank you very much for listening. If you enjoy this podcast, please consider liking it and subscribing to our channel so that you get our podcasts when they're released. Thank you very much.